Around 34 million UK adults are saving money every month, but they are not investing. And at current inflation rates, that distinction between cash that sits and capital that works is quietly costing them more than most people ever calculate. In this video, I break down the scale of the UK's savings to investing gap, why cash feels safe but carries a hidden cost, what the data shows about why people are not crossing the line, and the simple framework for deciding what money belongs in cash versus what should be working harder. The numbers here are striking. Research into UK investing habits found that around 62% of UK adults, approximately 34 million people, are not investing at all today. Not in a stocks and shares ISA, not in a fund, not in the market in any form. Of those 34 million, around 11.6 million say they are open to investing in the future, and approximately 4.3 million are already saving regularly in cash consistently every month, but have not yet made the move to investing. These are not people who cannot afford to invest. They are people who are already doing the hard part, building a saving habit, but stopping short of the step that would make that money work harder over time. According to BlackRock's research on UK investing habits, the barriers are not financial. They are psychological, and they are specific. Cash feels safe because it does not move. The number in your account does not fall, and there is no statement showing a loss. And for short-term money, emergency funds, or planned spending in the next year, that stability is exactly what you need. Cash is the right tool for that job. But cash has an invisible cost: inflation. UK inflation is currently running at roughly 3.3%. The Bank of England's base rate is 3.75%. On paper, that looks like a positive territory. Your savings rate is above inflation, but most easy access savings accounts are paying significantly less than the base rate, which means for most UK savers, the real return on their cash after inflation is close to zero or negative. Let me explain how inflation can erode the real value of cash, and let's look at a simple example. If you keep 10,000 in cash, earning 0% interest, and inflation averages 3% per year, after 10 years, the actual buying power of your cash would only be 7,400. Even though the balance remains the same, you've effectively lost 2,500 of spending power due to inflation of prices over time. This will be the case for any rate of interest lower than 3% that you earn on your cash savings. The money does not disappear, it just buys less every year, quietly, without any single moment where the cost is obvious. And that's not a reason to panic, it is a reason to understand what cash is for and what it is not for. Now, let's understand the real cost of not investing. The numbers here are stark. Research published in late 2025 modeled what happens when you take the same monthly commitment, the same discipline, and the same consistency and direct it into investing rather than a savings account. Starting with £1 and adding £30 every month from 2000 to 2025 into a broad equity index, by May 2025 that had grown to over 33,000. The same contributions going into a savings account over the same period produced roughly 12,000. That is a gap of over 20,000 from the same monthly commitment over 25 years, and the only difference was where the money went. This is not a guarantee. Markets can fall. Past performance is not a reliable guide, but it illustrates the compounding difference between cash that earns a nominal return and capital that participates in economic growth over time. The cost of not investing is not zero. For long-term money, the cost is the difference between those two bars. There is interesting research exploring why people choose not to invest, and the research is clear that the barriers to investing are psychological, not financial. Around 35% of non-investors say they do not know enough about investing to get started, and roughly 31% are afraid of losing money, and approximately 26% believe that they do not have enough money to begin, and roughly 21% 20% worry that they will not be able to access their money once it is invested. Notice what is not on that list: income, debt, inability to save, and the people holding back are not financially excluded. They are uncertain, and uncertainty is something that can be addressed with information, not with a better product or a higher income. The knowledge gap is the most actionable barrier of the four. If you understand what you are doing and why, the fear of loss reduces. If you understand that you can access AISA money anytime and pension money from age 55, the access concern disappears. The barriers are real, but they are not permanent. The most useful reframe is this: stop asking, should I save or invest? And start asking two different questions instead. Question 1: when will I need this money? If the answer is within the next 1 to 2 years, keep it in cash. Stability and access matter more than growth for near-term money. Emergency fund, planned purchase, and upcoming large expense, cash is the right tool. Question 2: what is this money for in the long term? If the answer involves a goal that's 3 or more years away, retirement, financial independence, long-term wealth, cash is the wrong tool for that job. Not because it is risky, but because it is too slow. Inflation erodes it. Compounding cannot happen inside a savings account at 2%. This is not a revolutionary insight. It is a framework that analysts, wealth managers, and institutional investors have used for decades. Split your money by purpose and time horizon, not by what feels comfortable. For anyone who identifies with a 4.3 million already saving regularly, just not yet investing, the process is simpler than most people expect. Identify the money that has a long-term purpose, not your emergency fund, not money you will spend in the next year, the money that's sitting in cash without a specific near-term job. That's the money worth putting to work. Open a stocks and shares AISA. The annual allowance is 20,000. Contributions can start from as little as £25 per month on most platforms. The AISA wrapper means all growth and all withdrawals are tax-free. Start with one fund, not 10 funds, not a complex portfolio. A single diversified global index fund covers thousands of companies across dozens of countries and is the simplest accessible starting point for a new investor. The previous video on this channel covered exactly why one fund is often enough. The UK does not have a savings problem. It has a conversion problem. Millions of people are already doing the discipline part, building the habit, putting money aside every month. The gap is not income or willpower. It is a step between cash that sits and capital that works. Cash is a tool. For short-term needs, it is the right tool. For long-term goals, it is the wrong one.